I'm going to do something you're not supposed to do in either public speaking or broadcast journalism, and that is bury your lead, but I'm going to tell you this right from the outset. Over the last 5.5 years of production, we've emerged as the lowest cost producer in the world across all publicly traded companies. And in addition to that, we are currently engaged in a trade action in the United States called a Section 232 trade action that, whether right now it's being realized by everybody or not, may very well have an impact on our entire space, both inside the United States and outside of the United States. So with that as a preface, let me just say that what you're looking at here is our brand spanking new processing plant in the Great Divide Basin of state of Wyoming. We built this out in 2013, and our finished product is yellow cake. We ship it out the back door in 875-pound drums, and at our current offtake prices of about $50 a pound, each one of those goes out the door at about $43, $44 a pound. Sir, could I ask you to start the clock so I don't want to run over into the next guy's time? Thank you. Just by note, that's my disclaimer, and that, believe it or not, that's the abbreviated version. I once rewarded our general counsel by allowing her to read that at our AGM, so there it is. I'll give you our company at a glance, and what I want to do is just give you a brief overview, and then I'll go into this in more detail. But over the course of the last 5 years, as I mentioned, we have emerged as the lowest cost producer in the space, and this wasn't easy. We spent more than 7 years as a permitting story in the United States. We got our final record of decision in October of 2012, and we spent the next 9 months building out. But we completed our processing plant on time and on budget, which if any of you are as investors in the extractive industry, you know that that's a rarity. But we have now produced nearly 3 million pounds there. We've become that lowest cost producer. But what we have done is that we have lowered our production down to what we consider to be market appropriate levels because we're still very challenged in terms of pricing. At the present time, spot price is $29 a pound and term price is about $32 a pound. Cameco, as you know, has said that, hey, while they like the positive price action, and we were one of the best performing commodities in 2018, but the fact is that we're not yet at a price where most of us can make money, and hence Cameco shut down the largest facility in the world at McArthur River. We've been served very well by very long-term and flexible offtake contracts. We put these in place after Fukushima. I'm just old enough to remember 3 Mile Island. And so we put long-term contracts in place going all the way out into 2021 at an average price of right at about $50 a pound. And we have been very well served by these revenues. As a matter of fact, we are the only company in a very challenged industry that has been cash flow positive for the last 3 years. And has solid contracts going into this year as well. And right now that's a rarity in this industry. But what we've been forced to do, and we'll go into this in a little bit of detail, is that the United States has placed itself in a very precarious and very dangerous position with respect to its fuel supplies for nuclear fuel, where we have become dangerously dependent not only on foreign countries, but on countries such as Russia, Kazakhstan, and Uzbekistan, and you do not want to be dependent on Vladimir Putin for critical fuel. One of the things that I'd like to focus on just for a couple minutes here is I'd like to address the supply and demand fundamentals of our industry. It's important to understand that we are actually a growing industry. Demand is growing. The industry itself is characterized by growth. In the United States, we are not alternative energy. Nuclear fuel accounts for 20% of the grid in the United States, and we are 62% of carbon-free emissions in the U.S. We have over 450 reactors up and running around the world, and 55 under construction right now, the bulk of those being built out in China. The Japanese are restarting their reactors, but most importantly, on the bottom of this slide, are the new players that are coming into the industry. We've seen 3 national traders. Now, that normally wouldn't be a big deal, but in this case, it's Russia, China, and Kazakhstan, the biggest players in nuclear outside of the United States. We've got uranium-only hedge funds that have come into existence, and we've got physical players, not just hedge funds themselves that are buying physical positions as a speculation, but the physical-only funds like Yellowcake PLC that went public in London. They've picked up about 15 million pounds in 2018. And I think most importantly, Cameco, the biggest publicly traded company, the only in uranium, has become a buyer in the uranium space because they have decided that it makes more sense for them to purchase low-cost pounds in the market and deliver those pounds into their contracts and leave their pounds in the ground. We've been doing that for 3 years. It's not enough to have growing demand. Here on the supply side, as I mentioned with Cameco, they shut down McArthur River, 18 million pounds a year. Converdyne, our only converter, shut down in November of 2017, and we've seen further closures throughout the world. Last year in 2018, more than 20 million pounds came offline. That's significant in a marketplace that consumes about 190 million pounds a year. Overall, the supply-demand fundamentals look very good. According to the WNA, global demand is going to be right at 193 million pounds. It was in 2018. Global primary production was only 138 million pounds, so a 58 million pound reduction. That's expected to be 65 million pounds next year. Here we have this is what we're focused on. We're focused on the situation here in the United States. There are only two producers left in the United States, ourselves and one other by the name of Energy Fuels that also happens to be our co-petitioner on the Section 232 trade action that we're bringing. But the United States consumes over 50 million pounds a year. We are the largest consumer on the planet. We have 99 reactors up and running, and we consume over 50 million pounds consistently. 7 out of the last 8 years, we have purchased more than 50 million pounds to meet our nuclear fuel needs. Sadly, we have gotten to the point now where primary production in the United States has slipped to less than 1 million pounds a year. What that means is that we are importing 98% plus of every pound of nuclear fuel that we need, or U-308 equivalent that we need to power our nuclear reactors, are coming from outside of the United States. That is absolutely unacceptable from a national security standpoint. And the really challenging thing about that, and the real dangerous aspect of that, is that more than 40% of that is coming from Russia, Kazakhstan, Uzbekistan, and increasingly China. So this is something that we decided this is not a level playing field. The only reason that they can continue to flood the world with material is because they're subsidized by their governments. They have devalued their currency, the tenge in Kazakhstan, by more than 90% over the last 4 years, and they have no environmental standards. Anybody can look like an economic marvel when you have no standards and you've got a currency that's been devalued by 90%. So we brought Section 232. This is critical, and whether, as I mentioned this right from the outset, whether people understand this or not, the harsh reality is that the outcome of Section 232 is going to have a significant impact, not just in the United States, but on all the players outside the United States. Now, I'm assuming that most of you have something to do with uranium and are uranium investors in some way, or you wouldn't be in here. Whether you're an investor in just the United States plays or outside the United States, the big explorers, this is going to have an impact on you because it will have an impact on pricing potentially for many years to come. It's not too late. We can do something to save the fuel cycle in the United States, but there's a bigger issue involved here, and I want to stress this. This isn't just about whether or not a couple of small companies can stay in business. If the United States does not keep the fuel cycle alive, it means we lose our seat at the table globally. And right now, the primary deterrent to nuclear proliferation over the last 70 years in the nuclear age has been the United States. Otherwise, if we are not there to safeguard this, the proliferation will begin immediately, and it will expand very, very rapidly. This is a battle we must not lose. We're concentrated in the Great Divide Basin in the state of Wyoming, in the south central part of the state. One of the things that I'd like to emphasize is that we have 3 primary properties totaling nearly 50 million pounds, but they're all larger scale properties, and each one of them has the capability of coming into production within the next 5 years. We're already producing at Lost Creek, and we've emerged as the lowest cost producer in the world. But Shirley Basin we can bring on in about 2 years. With Section 232, we have had to put ourselves in a position where we maintain a high level of operational readiness. This has cost us a lot of money. It's cost us in between $9 and $10 million for the last 3 years to keep on our operational staff and make sure we're ready to ramp production. We see here on Lost Creek, we've produced nearly 3 million pounds at Lost Creek, but grown the resource from 6 million pounds at the time of Fukushima. Look at this bar chart right here. 2011 is the bar on your left. We had about 6.25 million pounds. Over the last 7-8 years, we have grown that resource at Lost Creek alone to 21.5 million pounds while producing nearly 3 million pounds. It's just turned into just a fantastic producer and one that we're very, very proud of. But Shirley Basin will be our second producer. We believe that we can have that up and running over the course of the next 2 years, and it has even a lower cost profile than Lost Creek does. If you take a look here, well, let me go on. Before I go on to Shirley Basin, we came out with our operational results on Monday of last week. And what I'm going to try and do here is I'm trying to give you an idea of where we are. One of the things I'd like to point out is that if you take a look here across the top, you'll notice the number of pounds that we capture and drum. And as that number of pounds grows, our costs right here come down. So there is an inverse relationship. The more pounds we produce, the lower our cost. And right now, we have come down to where we're only producing about 300,000 pounds a year. So our costs have been rising over the last couple of years as we have appropriately scaled back production. But nevertheless, we are in strong position because we've continued to produce. Right now, every pound that we're producing is going into inventory. But take a look at our operational results and our sales results down below here. One of the things that I would point out is in 17 and 18 here, what we've been doing rather than bringing our own pounds out of the ground, in 17, you'll notice there that we delivered 780,000 pounds. I purchased 2/3 of those pounds at $21 a pound. We sold them into the market at a little over $49 a pound, realizing $28 margins in a $21 spot environment. I'll say that once again, we were realizing $28 margins in a $21 spot environment. I don't know of anybody else that is doing that in any other commodity, I don't care what it is. Last year was more of the same. We purchased virtually all of our pounds, now a little higher price because we were a little further out on the yield curve. They're about $24 a pound, but once again, delivering into $49 contracts. And again, realizing margins of about $25 a pound in a $25, $26 spot marketplace. Next year in 2019, I'll be delivering 500,000 pounds, again at roughly $49 a pound. We expect gross profits of about $11.5 million. And so we find ourselves in a position where we not only have revenues in an industry that's virtually bereft of any revenues whatsoever, but we also find ourselves in a position where we are cash flow positive and generating profits. Shirley Basin now, take a look at this. This is actually going to be a lower cost producer than Lost Creek. We expect right out of the gates to produce at about $14.50 a pound. And we expect to be able to ramp this up over the course of the next 2 years. Here you have Lost Soldier. I'm not going to spend any time on it because it's about 4 or 5 years out, but this will be the third project for us. And again, it's about 14 million pounds. This has long mine life. So what we've been doing is we've been getting ourselves ready. We've been ready to ramp up. We're running lean and clean. One of the things that's important to understand is that typically a mine unit lasts for about 2 years, 24 to 30 months. That's about average. We've been operating the first mine unit at Lost Creek now for 5.5 years, and it's still cranking 10,000 pounds a month. That's absolutely extraordinary. It's virtually unheard of in the in-situ recovery industry. Our second mine unit, we've only started the first 3 header houses. There will be 15 there in total. But the point is that we've got 10 more mine units after this. So we've got minimum 20, 25 years of production at our first producer alone at Lost Creek. We've been working on our efficiencies. We've kept our operational staff on, and we're ready to ramp up at any time. We did a small raise in September that puts us in a position where we now have solid cash. I'll get into this in a moment, in addition to growing revenue or growing inventories. Here is how we expect to ramp up. I think this is important. If Section 232 is successful, it means that we will get long-term, lifeline, high-dollar contracts for the next 10 years that will sustain our company in very fine fashion. We expect that we can ramp up to about 2 million pounds a year and sustain it right along just off Lost Creek and Shirley Basin, and then bring on Lost Soldier in the 4th and 5th year. So this is important. This is what the utilities will be focused on, not just your number of pounds in the ground, or they don't care about that. They care about whether or not you can legitimately ramp up, at what cost and what time frame. This might be the most important slide in the deck. For those of you that are actually evaluating investments in the uranium space and U.S. investments, if you have any knowledge of the Trade Action Section 232, this is what you should be focused on. What is the CapEx? Let's assume that there's 3 or 4 companies that can all get to 2 million pounds a year. What is the CapEx to get to that 2 million pounds a year and to be able to sustain it? This is what the utilities are going to care about. They don't care about what your pounds in the ground are. At Lost Creek, for me to get to 1 million, 1.25 million pounds a year is going to cost me about 14 to 15 million. At Shirley Basin, since I'm building a satellite plant, it's going to be about 25 million. But $40 million gets me to the point where I'm at 2 million pounds a year and can sustain it for the next 10 years. I can do it at lower cost and in shorter time period and at less damage to my shareholders than anybody else in our industry. And there's only one company that gets to say that, and that's us. We've had this solid strategy in place. We put long-term contracts in place when nobody else had them back in 2011. One of the things that most people don't understand is that Fukushima occurred on March 11th of 2011, and spot pricing stayed stubbornly above $50, $55 a pound for more than a year after that. Why wasn't everybody putting $60, $65 offtakes in place? We were. We were putting a lot of them in place, and we put them in place all the way out to the end of the decade because we didn't know how long the downturn would last. And so we've been served very well by those contracts all this time. You can see what our revenues have been in 2018, and again, this is just what you saw on the other slide. But this is exactly what you could expect to see in 2019. I was just asked by a gentleman here in the second row, are you going to be profitable this year? Well, it depends. I've got about 400,000 pounds in revenue, in inventory right now, and our profitability, we're about to break even with these 500,000 pounds that we're going to deliver into the market at $49 a pound. That'll give us about a break even. If I want to be profitable on the year, I'll sell some of the inventory that we've been accumulating over the last year. I have to be incentivized by price. $29 does not incentivize me. But under a successful outcome on Section 232, all of a sudden prices could be dramatically higher in the second quarter of this year, and we're waiting to find that out. So the answer is that no, we're going to be at about a break even, but we could be wildly profitable depending on what we decide to do with our inventories. So notice here we have about 160 million shares issued and outstanding. Cash as at the end of the last quarter was just under $11 million in cash, and our inventories have a contract value of about $18 million, and we still continue to grow inventory every month. So we're in strong financial position. I have only raised $22 million since Fukushima. Compare that to any other company that you've seen in the last 8 years. They're doing raises every year just to keep the lights on. I don't have to do that. I've raised only $22 million in the last nearly 8 years now. I'll compare that with any other company in our industry. Okay. There we go. I think it's important to understand that this industry has changed quite a bit. I've got about 4 minutes here, but let me emphasize a couple of things. In the last 8 years, we have watched this industry go from having nearly 600 players. We had 585 companies in 2007. Now there are less than 40, and of those, there aren't more than 10 or 12 that anybody ought to pay any attention to. That's just what it is. And there are even fewer that are capable of getting into production at any type of a reasonable cost that would make them cash flow positive or be able to even justify bringing on production in this market environment. So we're truly in a unique position. Here's would be the second most important slide in the deck. If you're a uranium investor, note these things. This is important because the question becomes, what are the catalysts that are going to drive this space? What's going to push prices higher? The supply-demand fundamentals, we went through those. The demand is growing, the supply is dropping. It's the perfect storm. It's exactly what you want to see a market come back into equilibrium. But the market forces are even more pronounced. Cameco is going to need to buy in between 12 and 15 million pounds this year to satisfy its contracts, and they're not making those pounds at McArthur River anymore. But the Section 232 is going to have a profound impact. If Section 232 is successful, it means it's going to result in a bifurcated market. And what that means is that we're going to have a higher price, differentiated market in the United States compared to the rest of the world. Everybody else will have the same spot pricing, same term pricing, and the same Kazakhs, Uzbeks, and Russians dumping on that market. Only there's going to be far fewer players to buy those pounds. I don't know what that's going to do to spot price, but I will tell you this, since we filed Section 232, the United States utilities have not been in the market. And the reason being is that they're flush with all of the foreign material. And now at the prospect that they might have to purchase domestically produced pounds, they've been out of the market for the last year. They've only come into the market for what they absolutely need to purchase. That's critical to understand because let's assume that Section 232 is not successful and it's business as usual. The United States government decides to do nothing about it and it's not a national security issue. The fact is that those markets, those utilities then are coming back into the market. Our traders in New York seem to feel that in the absence of Section 232, if it's unsuccessful, the market probably goes up to $35, $40 a pound. And you know what that does to all of the equities if we go up to that $35, $40 a pound mark. If it is successful, then it's the bifurcated market that I just spoke of, and you will see higher prices in the United States as opposed to the rest of the world. So Section 232 is going to make a huge difference no matter what. The geopolitical risk simply cannot be overlooked. Look, the trade war is absolutely Mr. Trump's, but the Cold War 2.0 that seems to be ramping up and seems to be unrelenting is absolutely the Democrats. And this is something that I just don't see abating anytime soon. And if anything, the rhetoric seems to be ramping up, and I think that this is something that is going to get worse before it gets better. But one of the things that I'd like to emphasize is that I think we're in better position than anybody else to take advantage of this. We've done a great job of balancing between the pounds we purchase and the pounds that we produce. We're going to have a good year again in 2019 with 500,000 pounds under delivery. We should do about 11.5 million in gross profits. Our term contracts have served us extremely well. They will continue to for the next 2.5 years. We're the lowest cost producer in the industry, and this ramp up is, once again, this is critical. Ask yourself this question. This needs to be the question you ask if you're looking at the domestic players in the United States, the United States players. What is the CapEx to be able to ramp up? Again, assume that we're all going to try for that 2 million pounds a year, just call it that. What's it going to cost? What's the time frame? What's the CapEx to get there? That's going to distinguish our companies, and you do not want to be heavily diluted in that process. We are in a position right now where we have maintained operational readiness. We have the operational leverage. We can ramp up faster at lower costs and with less dilution to my shareholders. And by the way, I am the largest shareholder in my company. I have about 2.5% of the company. I've put 3.5 million shares in it at higher prices than we're at today. My wife wants to absolutely strangle me. But I'm a believer in this. I'm a big believer in eating my own cooking, and we believe that we are better positioned than anybody else. So with that, I'm out of time, and thank you very much for your kind attention.